Good morning. My name's Andrew Comer and I'm a partner at State Hammond. Today's the 19th of May 2020 and New Zealand has now had 5 full days at alert level 2. Communities are slowly coming back out into the open. Limits on the number of people we can associate with have been loosened and many schools, cafes and restaurants are now welcoming us back through their doors. However, small to medium-sized businesses up and down the country are still under varying degrees of financial pressure, and having readily accessible finance is now more critical than ever. In this installment of the ProAct series, we'll take a quick look at some of the options for you to obtain financing for your business. First up, we'll look at government support. So the government has a number of initiatives, both old and new, targeted towards small and medium-sized enterprises. Some of the key ones include the Small Business Cash Flow Scheme. Under this scheme, businesses with 50 or fewer employees can apply for an interest-free loan of $10,000 and an additional $1,800 per full-time employee. And this is to cover core business operating costs, for example, rent, insurance, utilities, or rates. Next, there's the Business Finance Guarantee Scheme. This scheme allows businesses to apply to their banks for loans of up to $500,000 for a period of up to 3 years. Note, though, that it's limited to businesses with revenue between $250,000 and $80 million. Next is the Regional Business Partner Network Support Scheme. Under this scheme, businesses with fewer than 100 full-time employees can apply for a government grant of up to $5,000. And this scheme is run through the COVID-19 Business Advisory Fund. And finally, the government and its agencies also provide a number of other grants which you may want to consider, including research and development grants, regional growth grants, grants for exporting products and services, and specific industry grants. Now we'll take a quick look at debt financing. It might be the way to go, particularly for businesses that don't want to share ownership. And some of the more common sources of debt funding are as follows. Bank loans. These are the most widely adopted source of debt funding. As a borrower, you can be expected to pay interest on the principal amount advanced to you. You'll also likely be asked to give security over the business's assets, and in most cases, banks will require a personal guarantee. If your business can't access bank financing, you may want to consider funding from finance companies. A lot of finance companies offer unsecured finance options. Others offer discounting or factoring-based finance options, in which invoices or accounts receivable are used as collateral to secure a loan. Finance companies typically charge higher interest rates than those of commercial banks, and this reflects the greater level of risk associated with their lending activities and the higher cost of funds to finance companies generally. A company could look to issue debt securities to investors, for example, bonds, bills, or convertible notes as another way of raising debt finance. With this approach, investors are essentially lenders who provide the company with a repayable investment loan. There are also other sources of debt financing, including friends, family, and existing shareholders, each of which will present its own issues. On the other side of the fence is equity financing, which is a well-established approach for a business to raise capital. It does this by issuing new shares in the company to existing or new shareholders, for example, to friends, family, angel investors, venture capital firms, or other institutional investors. Equity financing might be an appealing option if taking on more debt isn't financially viable for the business. The two most common types of share issued by companies include ordinary shares and preference shares. An ordinary share is the most basic and widely recognized form of company ownership unit. It will generally give its holder a right to vote at a meeting of shareholders, and it will also usually give the holder the right to share in the company dividends and in the distribution of surplus assets of the company on the company's liquidation. Preference shares will not normally give its holder a voting right in relation to the company. However, it gives its holder a preferential right over holders of ordinary shares. And this is typically the right to receive dividends the distribution of surplus assets on liquidation, or the distribution of sale proceeds ahead of ordinary shareholders. And note that preference shares can be issued as being convertible into ordinary shares or redeemable, that is, able to be repurchased by the company. And each classification will have its own unique benefits and downsides for the investor and the company. Now for some closing remarks. When looking to obtain finance, we recommend you pause and carefully consider what trade-offs you're being asked to make with your business. For example, how much of a stake in the business or how many directors do investors want? And are you prepared to concede on those fronts? Also, you should consider what kind of obligations you're being asked to sign up to. For example, what are the repayment terms of your loan? Can you justifiably give security over your assets? Are you in a position to provide a guarantee? Secondly, and particularly with equity financing, you'll want comfort that it ticks all the boxes under securities-related legislation, as the penalties for failing to comply can be significant. Key laws to watch out for include the Financial Markets Conduct Act, and if an overseas investor is providing financing and relevant thresholds under the Act are triggered, the Overseas Investment Act. So we recommend you seek legal, financial, and tax advice as soon as possible in connection with any financing activities you're planning to undertake. Finally, just note, this isn't an exhaustive list of all financing options available. It's a snapshot of some of the more common approaches you may want to consider. Feel free to like this video, subscribe to it if you want to watch more videos in our ProAct series, and there's a link in the description below to allow you to sign up and be notified about future articles. Thanks very much.